Today, is risk hiding in plain sight? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. We'll deepen the financial system plumbing. Risks are rising. And the question is, will something break as rates are hiked and liquidity withdrawn? Massive Federal Reserve buying of Treasuries stabilised the market over the past couple of years, but liquidity gauges have eroded since the purchases stopped. The market for US Treasuries has grown to more than $24 trillion, expanding nearly tenfold over the past 20 years, at the same time that major regulatory changes have blunted the ability of some bank-owned dealers of government debt to increase their purchases. The Fed is this month accelerating the pace of winding down the nearly $9 trillion balance sheet it built up for more than a decade in an effort to cushion the economy from shocks. And it aims to shrink the total by $95 billion a month. That's double the August pace. Yet, in fact, the Federal Reserve weekly assets went up last week, which is weird given the fact that quantitative tightening is meant to have started, and we did see a fall in total assets, less eliminations over recent weeks. But on the 14th of September, the balance was reported at $8,832,759,000,000, whereas the preceding week it was $8,822,401,000,000, so a net rise of $10.36 billion. And looking down the list of assets, we see that US Treasury securities fell by $3.73 billion, the bulk of which was bills, while mortgage-backed securities rose by $9.23 billion. On the other hand, reverse repos rose by $66.8 billion. That is, of course, money parked at the central banks by financial institutions on the liability side. Right now, when bonds held by the Federal Reserve mature, the central bank churns the money back into the market. When it stops doing that, investment banks, known as dealers, must mop up any excess paper in the system on top of any new bonds that the US Treasury issues. Now, it's not certain that the commercial sector has the stomach for this, actually. The Bank of America head of US rate strategy, Mark Cabana, said dealers will inevitably be holding more Treasury inventory. They're going to have to finance that, which puts upward pressure on repo rates that over time will probably contribute to more volatile Treasury markets, potentially worsening Treasury liquidity. So this is all looking a bit messy, and a signal that there are indeed liquidity pressures emerging. In fact, the US Federal Reserve's more rapid exit from crisis-era policies is placing the $24 trillion US government bond market under extreme strain, heightening concerns about the bedrock of the global financial system. We could have a problem of liquidity stress in the banking system, said New York University economist Viral Akara. And whenever banks are stressed, it usually spreads over to non-banks and Treasury markets and other funding markets. Bank of America has described the Treasury market strains as arguably one of the greatest threats to global financial stability today, potentially worse than the housing bubble of 2004 to 2007. In fact, two recent precedents loom large: the 2019 crisis in the short-term lending market known as repo, and the 2020 Treasury market meltdown. In the first episode, the overnight market where banks lent cash to other institutions in exchange for high-quality collateral like Treasuries froze. Then in March 2020, the Treasury market gummed up as firms rushed to get cash, in part by selling US government bonds. Both cases imperiled pillars of the global financial system, drawing in the Fed to stop the rot. At the heart is this problem, as discussed in a recent Jackson Hole paper. While central banks' purchase of assets, known as quantitative easing, stimulates growth in bank deposits and lines of credit, reversing it does not necessarily lead to banks reining those in, even as it sucks cash out of the financial system, the paper says. Instead, the risk is that in a moment of stress, market participants all rush to claim short-term funding for instance tapping credit lines when there is not enough to go round. And the Fed actually admits that it's unsure what the impact of its QT programs will be. Fed Chair Jay Powell said after the central bank's meeting in May, "I would stress how uncertain the effect is of shrinking the balance sheet." And he later said, "By all assessments, the market should be able to absorb this." In fact, Fed officials have offered rough estimates of QT's impacts, including Vice Chair Lyle Brainard, who assessed that it could be equivalent to 2 or 3 quarter-point interest rate increases. And recent research published by federal staffers reached similar conclusions. Michael Howell, chief executive at Cross Border Capital, that's a London research and investment house, said that he has long held fears that quantitative tightening may have more effect than central banks will fess up to. A measure of market depth calculated by JP Morgan that looks at 2, 5, 10 and 30-year treasuries shows the worst liquidity since the northern spring of 2020. With supply flooding the market, treasury buyers could pull back in the expectation of better pricing in the future. Potential breaking points could come at quarter or year ends as banks withdraw from funding markets to pretty up balance sheets for reporting deadlines. The authors of the report said that a 2019 clog-up in the repo market was not a principal concern, and they pointed to the $2.2 trillion pile of cash sitting at the Fed's reverse repo facility, which is a bolt hole where investors earn a bit of interest on money that has no better use. And of course, the reverse repo facility was barely used as recently as 2021, but they now say, "I don't see a repo blowout as a risk to the financial system until the RP is drained down to zero." But bid-ask spreads, which is a measure of liquidity that captures the gap between buying and selling prices, have in recent months reached the widest levels since May 2020. Now, some investors are relaxed, in part because they assume the Fed will actively avoid any cracks. For example, PIMNO economist Tiffany Wilding said QT does not create systemic risk because the Fed controls it and the Fed will never allow it to be systemic. But other investors welcome the possibility of QT knocking risk assets from levels that they have seen as unsustainable. Dan Zerwin, chief executive at Arena Investors, a private credit firm, said systemic liquidity shock is a fancy way of saying panic, and panics are what markets do. That's the way asset bubbles are corrected. That's the way institutional memory occurs, delaying the next bubble from happening. Otherwise, you systematically misprice risk. In corners of Wall Street, though, some have been pointing out that those risks do exist. One stark warning landed earlier this month when the Bank of America warned the bank's clients that declining liquidity and resiliency of the Treasury market arguably poses one of the greatest threats to global financial stability today, potentially worse than the housing bubble of 2004 to 2007. So how could the normally staid Treasury market become ground zero for another financial crisis? Well, Treasuries play a critical role in the international financial system, with their yields forming a benchmark for trillions of dollars of loans, including most mortgages. And first, around the world, of course, the 10-year Treasury yield is considered the risk-free rate that sets the baseline by which many other assets, including stocks, are valued against. The reserve status of Treasuries confers myriad benefits to the US government, including the ability to finance large deficits relatively cheaply. Treasury debt is considered a global asset reserve, just like the US dollar is considered a reserve currency. This means it's widely held by foreign central banks that need access to dollars to help facilitate international trade. To ensure that Treasuries retain this status, market participants must be able to trade them quickly, easily, and cheaply, wrote Fed economist Michael Fleming in a 2001 paper entitled Measuring Treasury Market Liquidity. But outsized and erratic moves in Treasury yields aren't the only issue, since the bonds themselves are used as collateral for banks seeking short-term financing in the repo market, often described as the beating heart of the US financial system. So it's possible that if the Treasury market seizes up again, as it has done nearly in the recent past, various credit channels, including corporate, could actually blow out. That would thin liquidity, and it comes with a host of other drawbacks for investors, market participants, and federal government, including higher borrowing costs, increased cross-asset volatility, and in one particular extreme example, the possibility that the federal government could default on its debt if auctions of newly issued Treasury bonds cease to function properly. QT will further exacerbate thinning liquidity unless another class of buyers arrives, making the present period of Fed tightening potentially far more chaotic than the previous episode, which took place back in 2017 and 19. Since banks' balance sheet space is lower than it was in 2017, it's more likely that other market participants will have to step in. At some point, high yields should attract new buyers, but it's difficult to say how high yields will need to go before that happens. Although, as the Fed pulls back, it seems the market is about to find out. And to be sure, Treasury market liquidity has been thinning for some time now, with a host of factors playing a role, even while the Fed is still scooping up billions of dollars of government debt per month, something it only stopped doing in March. Since then, bond traders have noticed unusually wild swings in what is typically a more staid market. In July, a team of interest rate strategists at Barclays discussed symptoms of thinning Treasury markets in a report prepared for the bank's clients that included wider bid-ask spreads. The spread is the amount that brokers and dealers charge to facilitate a trade. According to economists and academics, smaller spreads are typically associated with more liquid markets and vice versa. But wider spreads aren't the only symptom. Trading volume has declined substantially since the middle of last year, the Barclays report said, as speculators and traders increasingly turn to the Treasury futures market to take short-term positions. According to Barclays data, average aggregate nominal Treasury yield trading volumes has declined from nearly $3.5 trillion every 4 weeks at the beginning of 2022 to just over $2 trillion now. At the same time, market depth, that is, the dollar amount of bonds on offer via dealers and brokers, has deteriorated substantially since the middle of last year. And other measures of bond market liquidity confirm the trend. For example, the ICE Bank of America Merrill Lynch Move Index, which is a popular gauge of implied bond market volatility, was above 120 last week, a level signifying that option traders are bracing for more ructions ahead in the Treasury market. The gauge is similar to the volatility index, the VIX of Wall Street, the fear gauge that measures expected volatility in equity markets. The MOVE index nearly reached 160 back in June, which is not far from the 160.3 peak from 2020 seen on March the 9th of that year, which of course was the highest level since the financial crisis, triggered by COVID. Thinning liquidity has had the biggest impact along the short end of the Treasury curve, since short-dated Treasuries are typically more susceptible to Fed interest rate hikes, as well as changes in the outlook for inflation. Also, off-the-run Treasuries, a term used to describe all but the most recent issues of Treasury bonds of each tenor, have been affected more than their on-the-run counterparts. Because of this thinning liquidity, traders and portfolio managers need to be more careful about the sizing and timing of their trades as market conditions grow increasingly volatile. Liquidity is pretty bad right now, said John Luke Tyner, a portfolio manager at Aptus Capital Advisors. We've had 4 or 5 days in the recent months where the 2-year Treasury has moved more than the 20 basis points in a day. It's certainly eye-opening. When chaos upended global markets in the spring of 2020, the Treasury market wasn't spared from fallout, which came surprisingly close to causing global credit markets to seize up. As brokers pulled liquidity for fear of being saddled with losses, the Treasury market saw outsized moves that made seemingly little sense. Yield on Treasury bonds with similar maturities became entirely unhinged. In fact, between March the 9th and March the 18th, bid-ask spreads exploded, and the number of trade failures, which occur when a booked trade fails to settle because one of the two counterparties doesn't have the money or the assets, soared to roughly 3 times the normal rate. Now, the Federal Reserve eventually rode to the rescue then, but market participants have been put on notice. And so, if regulators seem complacent when it comes to addressing these risks, it's probably because they expect that if something goes really badly wrong, the Fed can simply ride to the rescue as it's done in the past. But But the question you have to ask is that a structurally sound strategy for the US public debt to become increasingly reliant on Fed QE? The Fed, of course, is the lender of last resort to the banking system, not to the federal government. And just to add a little more spice to the debate, the Securities and Exchange Commission last week proposed rule changes that would enhance risk management practices for central counterparties in the US Treasury market and to facilitate additional clearing of US Treasury security transactions. At the moment, around 13% of all transactions are cleared. The rest are handled on a bipartisan basis, which means, of course, that there's a higher risk involved. So they say the proposed rule changes would require to update the membership standards required of covered clearing agencies for the US Treasury market with respect to a member's clearance and settlement of specified secondary market transactions. Additional proposed rule changes are designed to reduce the risks faced by a clearing agency and incentivize and facilitate additional central clearing in the US Treasury market. The Securities and Exchange Commission plays a critical role, they say, in how the Treasury market functions, including to help ensure that these markets stay efficient, competitive, and resilient, said the SEC Chair Gary Gessner. One aspect of that role is our oversight of clearing houses for Treasury securities. While central clearing does not eliminate all risk, it certainly does lower it. In 2017, however, only 13% of Treasury cash transactions were centrally cleared. Thus, I think there is more work to be done with respect to the amount of Treasury activity that is centrally cleared, and I think that these rules would reduce risks across a vital part of our capital markets in both normal and stressed times. The proposing release will be published on sec.gov and in the Federal Register, and the public comment period will remain open for 60 days following publication of the proposing release in the Federal Register. Now, this is a big deal because essentially they are trying to put more regulation around the trading, particularly in the secondary market, of US Treasuries. And of course, the question is, what's prompted it? Is it simply the timing, or is there something behind the scene here insofar of the mounting risk that we discussed earlier in terms of lack of liquidity and all of those issues? I'm not sure. But I do think it will put further pressure on Treasuries. And the question, of course, as the Federal Reserve continues to quantitatively tighten, how this is all going to play out. I think the risk that I see is that this could accentuate further the risks across the sector. And because, as I've explained earlier, US Treasuries are so critical to the way that the overall financial system runs, not just in the US but globally, there are systemic risks here which are building, and I wonder whether they are fully understood. We should be monitoring this very closely in the weeks and months ahead, but I suspect we're going to hear a lot more of pressure on Treasuries. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.